welcome to the fourth episode of Mastering Futures and Options. I am Anusha Banerjee, and joining me today is Amardev Singh, Senior Vice President, Angel One Research. Now, in this episode, we shall be talking about open interest and how it can be used by different participants in the market. So, whether you are new to trading or looking to enhance your knowledge, this series will focus on valuable insights and practical tips. So, diving into the conversation, first up, please help us decode what exactly is open interest.
Yeah, this is I would say open interest is a very popular term in the derivatives segment, be it futures or options. So open interest actually stands for the number of outstanding contracts. That is the contracts which have not been squared off. So suppose there are traders who buy call options or buy put options or buy futures or short futures. So whenever a new trade happens, you have something called the open interest built up that happens. Making it even clearer for our viewers, I'll take an example. So suppose there is trader A. He buys 10 contracts of Nifty options. Then there is trader B, who again buys 10 contracts of Nifty. And then there is trader C, who buys 5 contracts of Nifty options. So if you look at trader A, B, and C, put together, they have 25 contracts, which are open, outstanding, means the positions have not been squared by these traders. Now, suppose, for example, trader A squares off 5 contracts. So earlier he had bought 10 contracts, he squares off 5 contracts. So the remaining number of contracts for him is 5. So effectively what was earlier 25, 10, 10 and 5 now becomes 5, 5 and 10. So effectively it becomes 20 contracts. So open interest is the total number of outstanding contracts for any derivatives instrument.
Now that we have clarity on open interest, can you maybe explain how it is used by different participants in the market?
Yeah, so open interest, when we look at it, you've got different types of market participants. You've got traders, you've got hedgers, you've got amongst traders, you've got the retail, then you've got the HNI, you've got the institutional. So all of them look at open interest. Now what happens in open interest is that when there is a sudden spurt in open interest, be it in stocks or be it in indices, that gives a clue. There is a jump in open interest. So that tells that there is something which is interesting that is happening in the market. And open interest, when you apply it along with technicals, so that gives you a better perspective of the market. Now, for example, there's something called long built up in markets, in derivatives. So long built up, what happens is that when the prices are going up and open interest is also increasing. So what that tells is that prices are going up and open interest is increasing. That means that buyers are confident and buying even at higher levels. So that's a very bullish sign. So long built up, if it's happening in the market, that's a bullish sign. Likewise, there's something called short built up. So in short built up, it's the opposite. So when prices are going down, while at the same time open interest is building up, that means sellers are even confident at selling at lower levels. So you've got fresh selling into the market at lower levels. So that tells that the market could fall further. So these are some major parts which I would say traders look at: long built up, short built up. Then there's something called long unwinding and short covering.
All right, as we move to the end of the conversation, I wanted to ask a question which comes in the comment section very frequently. Can we compare open interest data with other technical indicators to confirm the trend? Like, which indicator should we look for?
Yeah, so that's a very good question. That you always have to remember that open interest is not to be used in standalone. One. Talking about the technical indicators which one can use. So I would say that one should look at moving averages. And moving averages, you can look at a 10-period exponential moving average for a short-term perspective. From a medium-term perspective, you can look at a 30-period exponential moving average. Or for a higher time frame, you can look at a 50-period SMA, that is a simple moving average. And from a very long-term perspective, you can look at a 100-period moving average, simple moving average, or a 200-period simple moving average. So that gives you the trend. And the best part is you can apply these different these moving averages on any time frame. You can use it on a minute time frame. The chart can be a minute time frame chart or 5 minute. But ideally, you should not go below 5 minutes if you're trading options. The next point is that the slope of the moving average is very important. So price closing above the moving average is important, but the slope of the moving average is very important. So that is one thing that one should remember. Apart from that, you've got RSI is one indicator wherein one can use for overbought and oversold territory. So when the markets are in oversold territory, and the market is around support levels, and the long-term trend is up. So that can be a very good buying opportunity.
Okay, as we conclude, do you want to maybe shed some light on open interest as an indicator for making trade decisions?
Yeah, so open interest, which I've earlier said also, it's a secondary indicator. You need to understand that it's not a primary indicator. So just because an open interest is giving you some indication, you should not go and take the trade. That's a very important concept which people need to understand. So you should always use open interest in conjunction with technicals. So if you're using technicals, because you have to understand what is the direction of the market, whether the market is in an uptrend, whether the market is in a downtrend, or whether the market is sideways, and then you combine your understanding of open interest, the put-call ratio, the long belt up, the short belt up. So if you do that, then your probability of success increases significantly. And also, when you start looking at open interest, you start looking at the option chain, you start looking at the strikes where there is maximum buildup of the open interest. So you gain a different perspective, because I know of many traders who look only at technicals. There would be some who are basing their decisions on open interest. But if you want to, I would say, be ahead of the masses, then you have to have a combination of both technicals and open interest, always remembering or never forgetting that open interest is a secondary indicator. Price is the primary indicator, open interest is a secondary indicator, but a very valuable and useful indicator from short-term trading perspective, because that gives you ideas and clues as to which stocks to look at, when to enter, when to exit.
All right, Amar sir, thank you so much for those expert insights, and we hope that you have gained a lot of valuable insights from this episode. Now, do not forget to click on the bell icon and subscribe to our channel so you never miss an update. Stay tuned, as we have much more coming your way in the next couple of episodes. Thank you so much for watching.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.